kind of year will 1996 be? Stay tuned for some possible scenarios.
This is a special edition of Nightly Business Report, Investment Review and Preview, featuring Paul Kangas and the Nightly Business Report team. Nightly Business Report is made possible by Digital Equipment Corporation, engineering network information systems that help you turn uncertainty into opportunity. Digital, whatever it takes. Franklin and Templeton Worldwide form the more than $125 billion Franklin Templeton Group, global alliance of mutual funds and investment products distributed by investment professionals. A.G. Edwards, serving the investment needs of individuals for more than 100 years. A.G. Edwards, built on a foundation of trust, research, and commitment to investor success. And is produced in association with Reuters, which provides real-time and historical market data, news, and analytics over Quotron Advantage AE.
If you owned stocks in 1995, congratulations are probably in order because it was Wall Street's best year in recent memory. Last New Year's Day, the Dow Jones Industrial Average stood at just 3,838. At the same time, the long Treasury bond was yielding 7.9%. But indications that economic growth was slowing soon led interest rates lower, sending stock prices in the opposite direction. By March, the Dow had already broken 4,000, and that was just the start. As strong corporate profits rolled in, the industrials reached new highs almost daily and crossed century marks almost monthly. Ironically, serious profit-taking set in only after the Federal Reserve's widely anticipated move in early July to drop short-term rates. But after 2 months of sideways movement, it was back to the races in November as the Dow soared 319 points for its greatest point gain ever in a single month. The momentum led the Dow past the 5,000 mark and even past 5,200 until investors pulled back on December 18th. The 101-point drop on that day was the Dow's largest percentage decline in 2.5 years. Of course, what happened with the 30 stocks that make up the Dow Jones Industrial Average represents just the tip of the iceberg in terms of the overall market. And here to fill us in on the bigger picture is our old friend Bill LaFave of Aaron Krantz King Nussbaum. Happy New Year, Bill.
Right back at you, Paul.
Let's begin by checking the major indexes and see how they compare.
Well, the Dow was up 33.5%, the S&P a little better, NASDAQ even more so. The laggard of the bunch was the Amex.
All right, well, we know it was a good year for the industrials, but which of its components had the best gains?
Merck was the best. It's been recovering ever since the Clinton health care plan died. And Sears, of course, is a result of their Allstate spinoff. The stock made it up overnight, it seemed like. And Boeing, of course, was selling a bunch of planes.
Okay, let's move to the other side. Which Dow stocks were the dogs of 95, so to speak?
Well, there were only two that were down. The Bethlehem Steel had weaker prices, and Woolworth has much more restructuring yet to come. International Paper was the third worst, even though it was up.
Well, it was actually down 3/16 on the year. Hardly any movement at all.
Okay.
Now, moving to the broader market on the New York Exchange, excluding the Dow stocks, I see a couple that quadrupled here.
Well, Diana is a high-tech company. They're acquiring Seattle Satellite as communications, and Continental Airlines, of course, I think this is his third reincarnation, and it's doing real good.
Okay. On the negative side, on the big board, the losers.
Well, Bradley's is a retailer that went bankrupt, and First Banks of America had a lot of car loans out. They're experiencing more than they expected in losses, and it's a problem for them.
Okay, as we saw earlier, NASDAQ had the biggest overall gain for the year, 95, and that was thanks to the high-flying techs. And Ascend, I assume, is a high-tech winner?
Yes, and it ascended pretty well. It's an internet stock that'll split 2 for 1 on Friday. And C-Cube Microsystems, another technology company.
Okay, and which NASDAQ stocks got the most deflated?
Well, Porter McLeod National Retail, they're like other retailers, and Senior Designs is another one, the second worst one.
Huge percentage loss.
Yep.
Looking over the American Exchange, look at this one, BioVale.
Well, that was up 800 and some odd %. They were going to split the stock 2 for 1, and by the time they got around to voting on it, the stock was even higher, so they made it 3 for 1. I mean, this just keeps going. And thermocardiogram's got an FDA okay for a mechanical heart product trial.
Thermocardio systems, yeah,
Yeah.
right. And the Amex losers here.
Resort Income Investors is subject to an SEC investigation, and Polyvision is an information display company with big losses.
All right, Bill, it was a year of records for the Dow, for the number of days, for the new highs, for the number of trades on the big board, and yet, like almost everyone else on Wall Street, you were somewhat taken by surprise to the extent of the 95 rally. Was this a bull market that went out of control, a buying mania?
I think what happened was a lot of people didn't believe it in the first half of the year, and by the time we got, it flattened out in the summer. By the time we got to Labor Day, or September and October, then the institutions started to play catch-up, and they jumped on those big capitalization companies, like some of the stocks that are in the Dow.
Okay, Bill, let's look ahead. What do you think we can expect in the market in 96? We have a minute left.
I think you're going to see, excuse me, I think you're going to see lower interest rates. The long bond had a lot to do with, its 24% decline in yield had a lot to do with last year's big gain. So I think you're going to see a further decline in interest rates, perhaps down to 5.5% from the present roughly 6% on the long bond. And I think that that could mean another 10% up on the Dow and other big board indexes.
Okay, what are Lefebvre's picks for 96?
Well, let's go with Philip Morris. It's a carryover from last year. And then if you don't like cigarettes, try the gum. I like Wrigley, William Wrigley Jr. And I think lower interest rates are going to help the utilities. They were the only index that did not make a new high last year. So in that group, I'd say SCE Corp, that's the old Southern California Edison.
All right. Looks like you're still positive on 96.
That I am.
All right. I want to thank you very much, Bill Lefebvre, and wish you a very, very happy new year.
You too.
As Bill noted, last year's stock market performance was at odds with many traditional beliefs about how Wall Street is supposed to operate. To find out whether 1995 marked the start of a new era for stocks, New York Bureau Chief Scott Gervey consulted 3 noted analysts.
Joining us now are Abby Cohen of Goldman Sachs, Joe Battipaglia of Gruntel, and Bill Dodge of Dean Witter, market strategists all. Now let's see, the Dow Jones Industrial Average is up about 30%, a little better this year. Everybody who had projected that, raise their hand. What do we have going on here? Do we have an aberration, or do we have some whole new way of valuing stocks? Abby?
I think you have 2 different things going on. First of all, let's realize that at the beginning of 1995, stocks were extraordinarily cheap. Perceptions were blue, black, unhappy, and right now perceptions are happier. Perceptions now are where they should be. And I think in 1996, stock prices can go higher, but not by another 30 or 35%, at least not over the next 6 to 12 months.
Even with price-earnings ratios and things where they stand now?
Well, earnings have been exploding to the positive. Each quarter has been a positive surprise. I think the market can move by another 20% in 1996, based upon the fact that inflation will stay down, and I think that's the big story. The lower the inflation, the higher the multiples, the lower the bond yields, the best conditions for investors right now.
But there have to be some kind of risks. I mean, we're seeing some, like, hot IPOs these days. Isn't that kind of scary?
Well, I don't think the breadth of excitement in the IPO market is the same as we saw in the early 80s, and you don't have a valuation problem relative to interest rates at the present time. I think the big risk this year is going to be earnings, if there is one. I think expectations are mid-teens, analysts' estimates for 1996. I think we're going to be up more on the order of 3 to 5%, so there's some potential to be disturbed along the way by earnings coming up a little short of expectations. Economy is still slow and weak, and that's good for interest rates, and that's been the key to the valuation of this market for the last couple of years.
The considered wisdom is that presidential election years are good for the market. I'm not sure historically if that's really true or not. What do you think?
Well, it's actually the second best. We're coming out of the first best. This year, I think history would show you had about an 8 to 9% median return in the election year. So it's a good year, but the strongest was this year, which incidentally has a mean expected return of about 17 or 18%, so we almost doubled that.
The most compelling thing about the election next year, I think, is the message. Whether you're Democrat, Republican, or Independent, the messages are very similar in that regards, promoting investment over consumption, trying to get a balanced budget, limits to federal spending, all kinds of things that I think have a positive impact on the financial markets.
What about sectors? Is stock picking going to be really important? How about the high techs?
Stock picking will be critically important in 1996. I think the technology stocks still have an awful lot of spunk left in them, At the end of 1995, many of those stocks were hard hit, but the fundamentals in many cases remain quite strong. That would be true for semiconductor stocks, PC hardware companies, a number of the software companies as well.
How about those internet companies? Can we deal with price-earnings ratios in the hundreds?
Well, I can't get my hands around the web and things like that, but I can tell you that auto stocks to me look very attractive in the new year. The cycle's not dead. They're selling at discounts to their revenues, certainly low multiple valuations. They could be big performers, and I certainly know what a car can do as opposed to the internet.
That's really very interesting. I mean, do we tend to get excited by the latest flash in the pan and kind of ignore the basics?
Sometimes, and I think Joe's right about 1996, when the Fed aggressively lowers interest rates. Autos, auto parts, building materials, home builders almost always will respond in that year. So I think that's a good bet. Technology and finance have led us so far in the surprising move for some in 1995, and I think they're going to lead us higher in 1996 as well. And then one other group I'd put out as a favorite in a market year where we're up maybe 10 or 12%, something on that order, would be real estate investment trusts away from the retailing sector, industrial REITs and so forth. I think should do well as the yield curve steepens this year.
One thing that hasn't happened, of course, is there hasn't been much of an adjustment in dividends. Do you think payout rates are going to increase? Do you think they have to increase?
Those payout rates, in fact, have begun to increase, but from very low levels. Companies have had enormous cash flow and have decided that they have better things to do with the cash. They're using it to buy back shares, they're using it to reinvest in their companies, but what we are now seeing is an acceleration in dividend growth. It was stuck at 1% for 3 years in a row. It's moved up to 4 to 5%, and I think it could be 7 to 8% in 1996, still below, however, the growth rate in earnings and the growth rate in cash.
What are the vulnerabilities here? There've got to be some dangers. The budget deal falling apart, would that do it?
No, I think the budget is a mirage in itself, because we can agree to be balanced in 7 because everyone will be out of office by then. But the fact is that the deficit this year is the lowest it's been in 15 years, and that's what's giving the financial markets comfort. On a longer-term perspective, though, I think China is probably the thing to watch because they still are a communist nation. They want to do things their own way. They have a one-China policy involving Taiwan and Hong Kong. So interesting things might come about in that relationship in the coming years that we can't anticipate today.
You're talking about political kinds of things. What about from an investment standpoint? Are there foreign markets that American investors ought to be looking at?
I think 96 is the year that we go back to foreign markets and foreign investors come back here. We see good opportunities in emerging Asia and Latin America, but recognize for the past few months there has been a surge in buying interest by non-U.S. investors, first in our bond market, and I think in 1996 back in our equity market. Keep in mind that non-U.S. investors have had an attitude towards the United States. They have failed to recognize that we in fact have the lowest budget deficit as a percentage of GDP of any nation in the G7. They have failed to recognize that returns generated by our companies are double and triple what they are in many other countries, and they are at this point dramatically underweighted in the United States. 96 is the year they come back to our markets.
Thank you. We appreciate your coming in today. Abby Cohen of Goldman, Bill Dodge, Dean Witter, Joe Battipaglia of Grunthal. Thank you.
In contrast to Wall Street's unstoppability, 1995 will be remembered mainly as a year of budget gridlock on Capitol Hill. Senior correspondent Dennis Moore reports on the federal budget standoff and its implications for investors.
The partial shutdown of the federal government that began the weekend of December 16th and the budget impasse that produced it were hardly unanticipated, except apparently in Wall Street.
I was thinking of those alarm clocks that ring softly once and then get louder. I suspect that this will be like one of these alarm clocks, that if they continue this for several months, they'll get a repeated message in 1996 that the markets don't like this kind of confidence-destroying gridlock.
At the heart of the budget dispute, President Clinton's claim that the Republican budget balancing plans cut Medicare and Medicaid spending, environmental protection, and education far more than needed to balance the budget, versus Republican determination to carry through on the promises made in the contract with America. By year-end, the markets had built in substantial expectations that Republicans would get most of what they wanted.
The money markets right now are gambling that we are going to balance the...
Across every possible measure. But
In those industries plus utilities, everybody's looking at their partner, they're looking at their neighbor, they're trying to figure out how big they need to be to dominate their industry. And I don't think that has changed for 1996.
But we're not going to see the same pace that we saw in 95.
I don't know that we'll see an improvement. I think we'll see a similar pace. As hard as it might be to sustain 1995, I think we'll see a similar pace in 1996.
What about the structure of the deals? We saw a lot of stock deals this year. Is that likely to continue in 96?
Absolutely. With the stock market at these levels, while CEOs are brimming with confidence, as we said before, it's just becoming too expensive to pay cash for every acquisition. So because their stocks are well traded, they will use their stock more and more as an acquisition currency.
What about investors who want to play the merger game? Is there some advice that you can give to them?
Look for industries where you think there's got to be action, and look for the companies that run their businesses well, low-cost companies who are going to be desperately sought after by the big guys in the business. But it's a tricky game. The arbitrageurs can tell you that, especially after 1995.
And the industries that they should look to, again?
I expect in 96 to see telecommunications, media, and technology continue to combine as a trio. I expect to see healthcare activity, financial institutions, especially the insurance side, and the utility industry.
What about banks? Banks were some of the leaders in 1995.
There will be continued banking activity. There's no question about it. Some of the biggest mergers have taken place, but there will be more. We could cut the number of banks in this country in half and still have a vibrant and viable banking system.
Okay. Thank you very much.
Thank you.
Our guest, Mark Davis of Solomon Brothers.
One merged company may be more efficient than two separate entities, but when it comes to stock market predictions, even 5 experts can be inadequate for the task. That was certainly the case last year when the most bullish of our Market Monitor panelists called for the Dow to reach only 4,200. Well, with a little luck, maybe someone will come within 1,000 points this time around. Our panelists this year are split on the market outlook, with the bulls having just a slight edge. Elaine Garzarelli has the distinction of being the biggest bull in our herd. She's calling for the Dow to go all the way to 6,300 in 1996. The stocks she expects to do the best are the automakers, followed by banks and tobacco issues. And as befitting a bull, her favorite mutual fund category is aggressive growth. Elaine says she's optimistic because she expects a soft landing for the economy with no recession. Second in bullishness is Alfred Goldman, Director of Market Analysis at A.G. Edwards. He sees the Dow reaching 5,700 and falling back to only 4,950. Al sees the rally in financial stocks continuing, and he also likes the energy and healthcare groups. As for mutual funds, he feels the best prospects are international funds with heavy exposure in the Pacific Rim. And while he expects moderate economic growth, Al says the market is still a bull, and bulls tend to surprise on the upside. More moderately bullish is Eugene Peroni Jr. of Janney Montgomery Scott, who sees the Dow topping at 54.75 before it drops to 47.75. Among stock groups, he likes aerospace, healthcare, and oil service, although he also expects good performances by mutual funds that specialize in telecommunications or entertainment. But Gene is concerned about the prospect of inflation heating up, and we'll hear more about that when he appears on our program this Friday. Still bearish is James Stack of Investec, who sees the Dow hitting 5,400 before it falls all the way to 4,200. Like Goldman and Peroni, Jim likes stocks in the healthcare and energy areas, as well as gold mining. And in mutual funds, he's looking for international funds to make a comeback. Jim expects the economy to approach a recession early in the year, and he's looking for a washout in high-tech stocks. Finally, the most bearish of our panel is again Stan Weinstein of the Professional Tape Reader, who, like Stack, sees the Dow bottoming out at 4,200. But Stan agrees with our other panelists about the merits of drug and oil drilling stocks while favoring bond mutual funds. Stan says he expects a significant correction in this year's first half, followed by a much better second half. In closing, we'd like to wish you and yours a happy and prosperous New Year. And we hope you'll make it your New Year's resolution to tune in Nightly Business Report every night in 1996. I'm Paul Kangas. Thanks for watching. And as we leave you, here's a final look at some of the economic and business highlights of the year just passed.
Return of flight number
Nightly Business Report is produced in association with Reuters, which provides real-time and historical market data, news, and analytics over Quotron Advantage AE, and is made possible by A.G. Edwards, serving the investment needs of individuals for more than 100 years. A.G. Edwards, built on a foundation of trust, research, and commitment to investor success. Franklin and Templeton Worldwide form the more than $125 billion Franklin Templeton Group, a global alliance of over 110 mutual funds and investment products, including U.S. government securities funds. Digital Equipment Corporation, engineering networked information systems that help you turn uncertainty into opportunity. Digital, whatever it takes. And by the financial support of viewers like you. Transcript of this program, please send a check or money order for $4 to NBR Transcripts, P.O. Box 2, Miami, Florida, 33261-0002. Please include the date of the broadcast.
The Nightly Business Report is brought to you locally by First Bank System on behalf of First Bank and First Trust. 3M, maker of Post-it brand self-stick removable notes for home and office. And by Custom Business Forms, a local manufacturer of snap-apart and continuous business forms.